Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Stocks and bonds are faltering with increasing doubts about the rate cut in March. This is the theme we have been following since late last year, ever since markets began their extreme pricing of rate cuts. But currencies are somewhat stabilizing while equities have been grabbing the attention. When it comes to India, our very own HDFC Bank has been in the limelight post their results. Nifty itself didn't have a good day yesterday with a lot of FIIs selling. Good morning, JK. Your take on markets and the risk of sentiment.
Good morning, Swaraj. Yeah, just looking at the overall picture in the global economy, look at it. Jobs market in US is still tight. Their consumption is still holding up, confirmed from their retail sales data yesterday. Inflation is above targets everywhere and rising again in UK and Canada. Central bank commentary suggests that they are in no hurry to loosen policies, and all this, which had been ignored by the market, is now seeing a reality check. That's why you are seeing bond and stock market getting sold off. Of course, the still slowing Chinese economy and Europe put more pressure on the stocks, which are seen falling across. The one thing that's holding up things, still above water is the uh, liquidity, but that is gradually tightening as well. So when you look ahead, you can't be too bullish in these markets. At best, they can be in the higher ranges for some time before something gives in. So that's how the overall picture looks. But coming more specifically to yesterday's news, we had the retail sales number from US, which climbed 0.6% in December, beating expectation of 0.4%, and even the year on year was higher. The control data, which eliminates the more volatile factors, also was higher. In UK, inflation accelerated to 4% in December, and that was much higher than forecast, and also 3.9% that was seen last month, and that added to concerns that the central bank may need to keep the borrowing costs higher, or the interest policy rate higher for longer. Then we also had ECB President Lagarde that said, although it's likely that Eurozone interest rates will be cut later this year, it's not helpful that markets are pricing in the timing and pace of monetary easing so aggressively. And we had more members from, Fed also, not looking to cut rates in a hurry. That's the, indications that they have been giving. And in the morning yesterday, we also had the Chinese data that showed the retail sales falling significantly, and also the GDP number that was well below expectations. So the gloomy picture on the economy, at the same time inflation not relenting, consumption holding up in the US job market being tight. All of this, again, gave a push to the bond yields yesterday, and particularly the 2-year yield was up by about 12 basis points, and overall it has rallied nearly 25 basis points from the last week's low. And such rise in yields is actually now paring back on the rate cuts. So it's about 25 basis points, meaning now actually the rate cut being priced in for this year is around 140 basis points, as against 160 basis points that was being priced in. And significantly, cut in the March meeting is now closer to a 50% probability. So it's a even, they may or they may not cut, even in the view of the market. So that's a big change that we are seeing. So there is really not that much, to feel bullish about either the bond market or the stock market. The good news from US economy is actually bad news for the markets. So US markets did recover from their steep losses earlier in the day, but they did close again on the negative. Perhaps some bargain hunting, and also a few corporate numbers also helping. Then of course, if you look at the other markets, Asia and Europe was down big time, and as you mentioned, there has been big sell-off in the Indian market as well, which had fallen more than 2%, and indications are that today again we will be seeing lower opening. And but this does not, this actually clouds the fact that we had very strong rally in the last few months, and the fall that we are seeing now is only a corrective move, and that's quite healthy for the markets. But what will keep the market interested is how the policies evolve going forward, even as liquidity tightens, and that will be key for how the markets will move going forward. And the dollar, of course, had a move above 103.50 yesterday, and still looking a bit strong, particularly against the low yielder like Japanese yen. Commodity currencies also not doing well because of the slowdown in China, and also the fact that oil prices are still struggling to rise. Euro and GBP did find supports at 1.0850 and 1.26 respectively, mainly because of the hawkish statements from the respective central bankers. On the Indian side, looking at the big sell-off in the stock market, and also a big outflow of FIIs, more than 10,000 crores in a single day, that has not been seen for a long time. I think Rupee performed admirably well yesterday. Perhaps some inflows also matching with the outflows. Maybe we do see some, spillover effect of those outflows today. But key for further moves will be whether 8320 holds up on the upside, which it did yesterday. And if it does break, we can look at a retest of 83.30. But on the overall picture, looking at the flows that are expected in the coming weeks and months, I don't think Rupee is going to see too much of weakness, and the stock market related outflows, unless they continue for too long, I think we should be confined to the recent ranges in the Rupee. And the overall dollar, I think some more upside on the dollar is on course, but it will be more of currency specific. Currencies like UK pound and the euro may not fall too much, while EM currencies, which had gained a lot, are likely to be likely to be the big losers. And the Chinese yuan, of course, because of the deep economic troubles, it remains on the weaker side, which may have some influence on the Rupee not gaining even in spite of the flows. So this, the new year, after a lull for 1 week, has really been very active, and quite a lot of volatility everywhere, but still not a major trend that has evolved so far. Let's wait and see if it does in the coming weeks. Thank you.
Thank you, JK. And of course, it's very interesting to see how the themes have evolved, especially since last December. So basically, jobs market in US is still tight. US retail sales show consumer spending to be strong, while central banks are holding rates. So essentially, as JK mentioned, good news for the US economy is not so such a good news for the markets. So we have been seeing stocks falling and yields rising. On the China front, Chinese retail sales data also showed a weak picture of consumer spending, while the Chinese GDP has also been below expectations. Now, in the overall picture, US rate cut probabilities for March is now at 55%, and for our listeners who want to know it, at its peak, this probability was over 80%, if I'm not wrong. So that's a very interesting repricing that's been going on. For Rupee, we saw some big outflows, and from FIs which sold more than 10,000 crores worth of equities yesterday. We had seen some weakness in Rupee, and possibly there can be some spillover effects even today. And also we have the Chinese yuan, which may weigh on the Rupee direction. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial.